Okay. Hi everyone. So the topic that I have taken up for today is cost of capital, continuing the series of important corporate finance concepts. So first, starting off with what exactly is cost of capital. So cost of capital is nothing but the rate of return that the suppliers of capital, that is debt or equity, require as compensation for their contribution to capital. So in a firm, the suppliers of capital, who can be the suppliers of capital? They can be either lenders who will give us debt capital, or they can be your owners who will give us capital in the form of equity. These two are predominantly our primary source of capital, debt and equity. So the rate of return these suppliers of capital demand is known as my cost of capital. The formula for the weighted average cost of capital is WT, that is weight of debt, multiplied by the KD, that is cost of debt, multiplied by 1 minus the tax rate, because interest payments are tax deductible in most of the jurisdictions around the world. Sorry for that. Plus your WP, that is weight of preferred stock, multiplied by KP, that is cost of preferred stock, plus WE, that is weight of equity, multiplied by your KE, that is cost of equity. Now, second, coming to the components of cost of capital. So cost of capital is predominantly made up of three components. First is your cost of debt, the capital that you raise in the form of debt, the cost of that particular debt capital, then your cost of preferred stock and cost of equity. So there are a number of ways in order to calculate these three components. So we'll discuss that one by one. So first, coming to the calculation of cost of debt. So we basically have two approaches in order to calculate the cost of debt. First is the YTM approach. So what is YTM? YTM is the annual return that a bond investor earns if they buy the bond today and hold it until maturity. So there are two ways of calculating this YTM. One is using a financial calculator, put in the number of years of maturity, the face value, the current price, present value, and you'll get the yield or YTM. Another way is a formula, an approximation formula, which we can use in order to calculate YTM. So that is equal to, in the numerator, we have annual coupon amount plus face value minus current price divided by maturity. We'll add this particular amount to the annual coupon payment and divide it by face value plus current price divided by 2. So that's the approximate formula for calculating YTM. Next is the debt rating approach. So at times what happens is that we have to calculate the YTM of a debt security which is not publicly traded. So what we'll do is we'll use publicly traded debt securities with similar characteristics. Like for example, let's say I want to find out the yield or cost of debt of a debt security which is AAA rated and is a 10-year corporate bond. So I'll find out other similarly listed AAA 10-year corporate bonds and then interpolate in order to find out the uh, cost of debt for my particular unlisted debt. Then I'll multiply that by 1 minus the tax rate in order to get the final after tax cost of debt. Next is your cost calculation of cost of preferred stock. So for that, we have a very simple formula. Cost of preferred stock is basically equal to your preference dividend divided by the current market price. So this formula comes from the present value of annuity, present value of perpetuity formula, which is where present value is equal to the perpetual annuity divided by the interest rate. So if you replace that with these particular variables, you will get the same. So that's how we calculate the cost of preferred stock. And finally, we have the calculation of cost of equity, for which we have two ways. First is your CAPM, that is the capital asset pricing model, where the KE, that is cost of equity, is equal to the RF, risk-free rate, plus RM minus RF, where RM is the market return multiplied by beta. So beta is nothing but a sensitivity measure. It tells us how sensitive our stock prices are with respect to the market. And second is the bond yield plus risk premium approach. So as we saw earlier, how we calculate bond yield. So we'll first calculate the bond yield of that company's debt security, add a risk premium to it, and finally get our cost of equity. So this was a basic discussion about about cost of capital and its component and how we calculate. So thank you for today. See you in the next video.